We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Larry McDonald. Larry is a New York Times bestselling author and also the creator of the Bear Traps Report. Larry, thanks for joining me today. How are you?
Hi, Tom. Thank you, my friend.
It's great to have you back. You know, you and I have spoken a couple times in the past here. And of course, you're just releasing a book, which we'll get into here today. But, you know, you recently posted a chart, and we're looking at the past quarter here, the last quarter of 2023. And you recently showed this on your Twitter that it cost the US $834 billion to grow the GDP by $334 billion. So the question that immediately comes to my mind, is this an aberration or a path for how growth looks for the US going forward?
Well, in election years, going back, many 50 years, 100 years, ahead of elections, you have governments that typically do some crazy things because they need to stay in power. And now they're more motivated than ever because there's a lot of people that don't like Donald Trump. There's a lot of people that like him, but there's a lot of, but the don't like crowd really, really, really don't like him, right? So they will do anything in their power to stay in power. And they know what happened to Barack Obama. I mean, Barack Obama's a Hall of Famer in terms of being a politician. You got to respect that. In 2012, he destroyed Romney, but ahead of that, it really was a massive amount of austerity that potentially had that election a little tight at a couple points. But it's Obama was such a significant, Hall of Famer in terms of being a politician, connecting with the people. He lost a lot of seats in the House, but he still was able to keep that White House even under this sequester, which took spending from, 1.4 trillion, 1.3 trillion over like 4 or 5 years. It got down to like 450 billion. So you're real nasty austerity. And the current team in Washington, they all lived through this, right? These guys are smart guys. People make fun of Biden, but like they're political animals, and they have slow walked this colossal debt cycle to not to rig the election, but to give them the best odds possible. And they know Biden's a weaker candidate. And so what they've done is they've just, massively levered up, and everybody knows the numbers, but, we're spending a tremendous amount of deficit spending relative to GDP, and they just want to get past election day. Mm-hmm. And I think it's close to, I guess after Lehman, when Lehman went down, the fiscal and monetary response to Lehman was about just under maybe, 2.5, maybe 2.5, a little bit under 3 trillion. Now the fiscal and monetary response to the post-COVID world, and a lot of that's, some of it's Trump, but a lot of it's Biden. It's 15 trillion. Mm-hmm. And so all of this is going to play out over the next year and a half, where this is part of our book thesis, is where right now there's this tremendous amount of money in what we call financial assets. So there's 21 trillion in the NASDAQ 100, 21 trillion. And, when we had the inflation cycle in 2022, that 21 trillion, it was like 2021, it went down to about 12 during an inflation cycle. And so in 2021, we were about 20 trillion in the NASDAQ 100. It got down to about 12 at the end of by the end of 2022, and now we're back up to 22 trillion, close to, maybe call it 21 trillion, and that's 21 trillion in NASDAQ 100. But if you look at like what's in metals or what's in mining, you're talking metals and mining and oil and gas. You're talking like $2 trillion. Mm-hmm. It's not even it's a rounding error. And so what happens is as you go into a more certain inflationary regime, which is stagflationary, kind of like what we had in 2022, that's when you're going to have $4 or $5 trillion come out of the NASDAQ 100, go into value, go into hard assets, go into the Alcoas of the world, go into the the Barracks, the Newmonts, all these types of companies, and it's whether it be Rio Tinto or BHP, Bulletin, you've got a lot of companies that produce metals, and they very, very interest rate, I should say more inflation resistant, because they own so many hard assets.
So, that's an interesting thought experiment. And it's something that I've been thinking a little bit about here, Larry, is this idea that, we have so much spending, in a way, this spending overhang or hangover from the past 4 years, that where does this put us, let's say, if the Democrats win the next election? If all of this comes to pass, this spending overhang ends, and the markets really have to face the music here, how does that look for the Democrats if they regain power here?
Well, unfortunately, politicians don't care as long as they get their 8 years, and it's going to set up pretty, potentially really ugly, but they'll have 4 years to get through it.
Mhm.
And so a lot can happen in 4 years. So they're just playing for that, they want that 8-year term. But right now, the Fed's been in a higher for longer kind of, they're trying to help the White House, right? In the sense that they want to portray that they're fighting inflation. But it looks a lot like an Arthur Burns. Arthur Burns was the Fed governor that, really kind of like played with killing inflation, but didn't kill inflation. Then Volcker had to come in.
Mhm.
But it's looking very much like the Fed's softened the path a couple times. And every time they've softened it, I can send you the chart, we can show it to the viewers, but 1 year and 2 year and 5 year inflation expectations are exploding higher right now, exploding. So they opened the door literally a half an inch in December, a half an inch, just toward a softer path.
Mhm.
And they didn't even cut rates. They just talked about cutting rates. And that your we call break evens, your 1 year, these are inflation experts, have just exploded. And now you get a tight oil market coming into seasonality. Typically oil does pretty poor between October and December, January. Now you're coming into a real impressive seasonality for oil and gas. At the same time, we have a multipolar world. This is one of the themes of our book. A multipolar world is where, when the U.S. is the only game in town and a very formidable, force globally with a lot of friends and allies, that's a unipolar world. And
Mhm.
that's a great world for low inflation and nice supply chains that work very smooth and on time supply chains. But today it's a multipolar world where the U.S. is not the biggest dog anymore. We get interest on the debt's 80 billion a month. 80 billion a month. That's basically starting to crowd out defense spending.
Mhm.
And so you have a situation where the oil market, we're coming into a period where CPI and inflation expectations are bouncing. CPI hasn't bounced yet. They're slightly bouncing, but if oil bounces here into the summer with a multipolar world, a lot of tightness, and you look at backwardation, like a lot of people look at the curve, and the curve, this is a very complex thing, but when the curve starts to when the front end of the curve starts to go into backwardation, which means the front end months trade a little bit higher than so the 1 month, 2 month might be higher than the 3, 4, 5 month. That's a very bullish sign. And then you have this tension in the Middle East. So I think you get a surprise on oil, which puts the Fed in a real stagflationary box, because the bottom 60% of Americans are in a ton of pain. They can't really hike rates to kill inflation now, because they're going to really annoy the Democrats in election year. Elizabeth Warren was on Bloomberg yesterday, just pounding the table on Powell. And so the bottom, and she's right in the sense that the bottom 60% are getting hammered with interest rates on car loans have gone from 50 a month to 700 a month. You're just getting killed on inflation in the grocery store. McDonald says that the income's under $45,000 in America can't really afford McDonald's anymore. And so you've got all this like obvious pressure that the bottom 60% are in pain in an election year. And at the same time, oil prices in a tight market, you could get a very serious bounce here in the first, I guess, second quarter.
I think you bring up a really interesting point with, the fact that the Fed didn't come out and, let's say, explicitly or actively loosen monetary conditions, yet just the effect of them talking about opening a path to loosening has had that same effect. So how dramatic has that been?
Well, Goldman's out when our analysts at the Bear Traps report, so behind us, we run a Bloomberg conversation with institutional investors, so hedge funds, mutual funds, and pension funds in 20 plus countries. We've been doing it for over a decade, running this chat. So right behind me, the team's in New York, and we have 650 people in there. There's about 30 contributors. So 30 people are having the conversation, and a lot of people are observing. But they're brilliant. They're brilliant asset managers. They're people with skin in the game. These are not people sitting on the sidelines writing about the market. These are people that are in the game. And what I've heard the last couple of days is that the financial conditions easing is the fiercest since in decades, and it equates to about anywhere between 125 to 150 bips of rate cuts.
Mhm.
So they cut rates with their vocal cords, but they haven't cut rates, and so the 1-year Treasury is really restrictive for a lot of things, for a lot of consumers. The 1-year Treasury is very high in yield, and so that's pulling money away from the metals, away from hard assets, away from a lot of things. And bond issuance is really high, and the banks, like the super regionals, right? The super regionals now. These are not little banks.
Mhm.
These are your companies like M&T Bank, U.S. Bank Corp, Comerica. These are large, what we call super regional banks. They're down like 15 to 25% year over year, with the S&P up 30%. I'm going to repeat that. S&P up 30. The super regionals. Remember, U.S. Bank Corp's the 5th largest bank in the United States. They're not doing it as bad, but Comerica, Trust Financial, Truist, these things are down 25% with the S&P up 30.
Mhm.
You can look back your entire life on this planet Earth. You're not going to find that. And it's something that, AI is exciting, but as an investor, when the banking sector is diverging that much, you just have to be careful, because it's telling you there's a serpent in there. There's, tremendous losses on commercial real estate. There's tremendous losses on auto loans. The super regionals relative to the big banks just are in a really bad position, because when you suppress the cost of capital for so long, imagine just sitting on a beach ball. When you suppress that cost of capital as a central bank, which the Fed did from Lehman's failure to COVID, they suppressed the cost of capital in a incredibly irresponsible way. And this is all in our book. And when you do that, you encourage and you really incentivize risk taking from financial institutions and all kinds of players. And they just did things they shouldn't have done. We know they bought too many treasuries at low yields, right? That we know they bought too many mortgage-backed securities, because that's what blew up the banks last year. But now, you're sitting on trillions of dollars of commercial real estate loans, and a lot of that's concentrated in those super regionals relative to the big banks. And they just don't have the deposits relative to the big banks. They just don't have the capital. They don't have the hedging. They don't have like Jamie Dimon, this guy, he's a Hall of Fame banker. I mean, he has the deposits, and he has a team that knows how to hedge interest rate risk. And if you look around the regional banks around the United States, you can say a lot of them, did a very poor job hedging out that interest rate risk. And so that this situation with the banks blows up sometime. If that's what I'm trying to get at. If oil bounces, and as you can see, CPI is going to follow break evens and bounce. So break evens are viciously bouncing. CPI, and I could share a chart with you. Break evens are bouncing, but the the CPI hasn't really bounced yet. It's slightly bouncing. But if you get a big bounce in CPI inflation, then the Fed is forced to really try to enforce higher for longer, not just with their vocal cords, but actually try to actually act. And if they do that, they will blow up the super regionals. And that will very quickly stop the Fed. And that's when you get a fairly aggressive move higher in the metals.
Larry, you're bringing up a couple of these different risks for the banks. And you recently wrote that the Fed will have to provide relief to banks for their commercial real estate holdings as they're down from being a $3 trillion market to a $1.8 trillion market. So when do you see these losses starting to actually affect the banks in a material way?
Well, we saw this with Lehman. It's like a slow moving train wreck. Or what happens with banks is that when they sit in the boardroom, and over the last 2-3 years, the chief economist comes in, and clients have told me this personally in the chat that are in these meetings that have heard firsthand. The economist comes out a year ago and says, "Oh, inflation's coming down. The Fed's going to be cutting rates aggressively. We don't have to puke out these portfolios." So your two choices are: if you're sitting on bad loans like commercial real estate, you can puke it in the hole, puke it out, and take the loss, or you can extend and pretend and pray that Powell bails you out with rate cuts. Because it's true. If Powell cuts rates 150 basis points over the next year, a lot of these loans that are, if you think about interest, like, let me give an example. Apple issued a bond. Just try to compare the Apple bond to like a loan on commercial real estate, just because it's interest rates. When interest rates go up, bond prices go down. There's an Apple bond that's backed by Apple and the iPhones that was issued at par in 2021 that traded into the high 50s, 40 points. So if you have a commercial real estate loan that was issued at that time in say some large banks took on this loan, has it on their books, and that loan's down 20, 30, 40 points, right? Interest rates up, bond prices down, loans down in value. Now you can hold it to maturity, but if the Fed goes higher for longer, that forces that down. And all you have to do is look at around the world. And this happened in 2007, Tom. This happened in 2007. Tokyo Marine, it's a financial institution in Japan, Aurora Bank, PDD. There's been these banks around the world that are marking down their commercial real estate. And the one thing about global banks is that if you're a regulator in Japan, you make your banks aggressively mark down to reality your U.S. holdings much more than they would domestically. And so that's one of the old tricks of the book with regulators, because it's not their problem, right? It's the bank's problem, but they bought shopping malls and big buildings in Chicago and New York and San Francisco. So these Japanese banks, these German banks, and then you look at New York Community Bank, they've also taken some substantial hits in terms of what they admitted. So it's like a bad relationship when you have either the boyfriend or the girlfriend doesn't come clean with the truth right away. And this happens in every cycle. And all I can tell you is the spread between what we're seeing on the marks from Tokyo Marine to Aurora to PDD in Germany, and these are all U.S. assets now. These are international banks, but this is on their U.S. commercial real estate portfolio. This points to a big problem for the super regionals. And that's why, oh, by the way, the super regionals are down 20%, 25% year over year, and the S&P's up 30. So the beast in the market's already pricing this problem in.
Yeah, there's so many moving pieces to this puzzle. And Larry, I want to get your take on, let's say, the other side of this coin. We have data constantly coming from the Fed that says the economy is near full employment and that the economy is strong. I've been traveling through the US for the last several months and have heard exactly the opposite. Granted, this is anecdotal evidence from people on the street. But I wanted to ask you if you see a discrepancy in the data as is.
Well, if you're in Palm Beach and you've got $10 million in a money market fund,
Mhm.
your interest has gone from $75,000 to $80,000 a year to $500,000 a year in the last 2-3 years.
Mhm.
So 10 million bucks in a money market fund, you were getting $80,000 a year in interest in 2021. And now you're getting $500,000 a year in interest in 2021. That's a big, that's a big difference, right?
Mhm.
So it's real simple. Like on 10 million bucks, 10% is a million, 5% is 500,000 bucks. And so those people are supporting the economy. And when you see Wall Street strategists, they talk about, oh, excess savings. But the bottom 60% doesn't have that savings. And we know because the New York Fed lectured us, Tom, lectured us for 2 to 3 years, 2019, 2021, even 20, I think it was 19 to 22. They lectured us around how the average family has 400, not like the average, say, bottom 30% has only $400 in their checking account. And so inflation's crushing that. So it's two economies. I think that we've got these periods where the economy gets strong and we go back toward weak, back and forth the last couple of years. And we've been through this a couple times. And I think that it's very clear that if the Fed goes higher for longer, they create so much stress in the banking system, they create so much stress on the consumer side that it will bring back a very nasty economic kind of problem.
Mhm.
But so far it hasn't, and it's caught a lot of people off guard. And there's a lot of reasons why. And it goes back to that guy with the 10 million bucks. He's buying, if you look at stocks like, you look at stocks like Tiffany, or I mean, any kind of
Luxury
company
goods.
any kind of company like Ferrari any kind of company that sells to the look at the spread between American Express and like any kind of subprime lender. It's spectacular because American Express, is dealing with the upper 1%, and that American Express clients are the guys with the money in the money market fund that just got the 300% pay raise.
Larry, you bring up an interesting point about this idea of, let's say, wealth concentration. Obviously, we're seeing that in an extreme case in the stock market right now, with AI driving a lot of this growth, a lot of the upward pressure on the S&P and obviously the Nasdaq. But you know, I want to try to understand how you see that. Like, does that concentration of, these handful of companies driving growth, does that worry you?
Yes, it's worried. It's worried a lot of people for a long time, and it's getting more and more dangerous. What we make the point in our book is Americans don't realize their 401ks have been hijacked by, like you said, 12 stocks, and the concentration of wealth. I mean, the boomers in the United States have $74 trillion. It's between 74 and $77 trillion. The baby boomers, the millennials only have 8, and so as the boomers get older, like the oldest boomer getting close to 79, 80, the boomers are moving toward bonds because bond yields for the first time are offering a lot of yield. So that's pulling some money out of the market.
Mhm.
But the big stocks are not affected by interest rates as much because the Russell companies or any company with debt maturities, any kind of like company in the Russell 2000, smaller companies have a lot more difficult time dealing with interest rates up, especially retailers. Any company with leverage has been hammered because they have to refinance this portfolio of bonds. And so you've got this like winners and losers in the market because the Fed is pushing up rates. They're creating, like you said, they're pushing more and more money into cash-rich companies. Berkshire's doing well. The Cows ETF, COWZ, I think it is, that's doing great relative to ARK. So what happens is in the market, long duration equities, look at like CLOU, which is software companies, or ARC, or IPO, which is the Renaissance technology long duration type portfolio. Long duration means that they have kind of like cash flow over time, that they're not really profitable, but they made a lot of investments. And so the net, when interest rates are higher and inflation's higher, the net present value of those future cash flows, when you're in a high interest rate, high inflation environment, that net present value of all those future cash flows is worth a lot less if you're like a company that doesn't have any profits. So those what we call long duration companies that are, don't have much cash, but have like a lot of bets, a lot of investments in the fund, like these ARC type companies, or the companies like CLOU, they're what we call long duration. And those types of companies are dramatically underperforming Berkshire and COWZ, the cash, that's the cash cows ETF. And so that's the world we're moving toward. But what's happened is it's also that the Fed moving up rates is helping those cash-rich companies and those larger caps. And like you said, it's pushing more and more money in, and there's less and less people paying attention, because all you have to do is own a passive ETF, and you've got I guess 14% of the S&P is in, I guess, Microsoft, NVIDIA. Close to 14% is in just those two companies, Microsoft and Apple. I guess it's six. I guess it would be six. I guess it's the top three are close to 14%. And so you've got that really high concentration of wealth and eventually you run into either a regulatory problem, and you're seeing on the Hill there's a lot of people, this has been going on, but regulators are they're like police officers looking for drug dealers. It doesn't happen overnight, but it happens eventually. And so regulators on this antitrust stuff is a very significant problem for potentially Google, for Microsoft, or potentially Amazon. And these are all things that are going to play out over the next couple of years, because like you said, there's just too much concentration of US wealth, and it sets up a really dangerous situation, because the boomers are, they're getting older, and so there's a tendency for them to, if anything goes wrong, they're going to move right to cash, because cash pays a tremendous yield right now relative to, like, the cash yield in bonds relative to the yield on stocks is at a very dangerous level for stocks.
Mm-hmm. So if we take these two scenarios, one, the risks to the banks, and two being let's say the risks to the stock market, into consideration, Larry, just to make it explicit, do you see the risks to the banks as being a bigger threat at this point?
Well, the big banks, we do know in October, Bank of America and Citi were down 50%, like 47%. Mm-hmm. And so back then, interest rates were higher on the long end. And so there's a tremendous risk to the big banks, if the Fed loses control of the long end, because the big banks are sitting on a ton of bad investments where they're holding on to bonds, mortgage-backed securities, treasuries, commercial real estate, and those are all like one very low coupon bonds. Like I said, anything that's a 1% coupon, when rates go to 5%, that bond's now trading in the 70s. And so what the Fed's done, and with the help of Janet Yellen and Treasury, Treasury's been issuing tons of T-bills. So if you look back over the last 100 years, 50 years, 30 years, the amount of T-bills that Yellen's issuing relative to other Treasury secretaries is a very dangerous amount, because she's very, very smart. In some ways, it's very dangerous, but if you have an election to win, it's smart, because it issues lots of long-term bonds. A long-term bond, like think of a bond, you issue it at 1,000. If it's a 30-year bond, it moves literally like 1,000% more than a short-term bond. So say you issue $1 billion of T mature in like 6 months. If interest rates go up, no matter what happens in the world, that US T-bill is not going to move. It's not going to move. It's that $1 trillion, call it $1 trillion, call it $1 billion. $1 billion bond is not going to move. But if you issue $1 billion bond that's a 30 or a 10 and interest rates go up, that all of a sudden that $1 billion is moving down by hundreds of millions, or $1 trillion if say she. So Yellen could have issued over the last couple of years, potentially close to $500 billion, $1 trillion of 30 years bonds, 10-year bonds to lock in low rates over the last couple of years while rates were going up. But they didn't do that. They've been staying on the front end because she wants to support the market. And now you have a tremendous amount of debt that's rolling over the next year and a half, and she can keep piling into T-bills, and by issuing T-bills, she can keep financing the debt. But at some point, that drains what this is where it gets a little complex. It drains the RRP because you're issuing so many the T-bill yields higher than the RRP, Fed's reverse repo, and that starts to drain liquidity out of the system. So that's a situation that's coming this year. But she has an election to win. So she's the last year and a half, she's been issuing tons and tons of T-bills that don't move in price. Whereas if she had issued longer term bonds, those bonds would have moved a lot in price and created a lot more volatility in the market.
So, Larry, there's one piece of this that we haven't really touched on, and that's the idea that, there are several conflicts going on in the world. And I want to understand how that plays into your analysis here. Does that provide some of this uncertainty and, in some ways, this constraint on oil supply that could drive price higher as well?
Well, the multipolar world thesis is like from 1966 to 1980, we were in a multipolar world. We had Vietnam, Korean War. We had a lot of, Korean War was just before, but we had a lot of tensions in the Middle East. We had the OPEC crisis. We had a real multipolar world where the U.S. had less friends. From 1980 to 2000 was much more of a unipolar world where the U.S. was the kind of the big boss on the sidewalk. And so what we found in our research is when you're in a multipolar world with higher inflation, like inflation that normalizes at 3 to 4% instead of inflation that normalizes at 1 to 2, that creates a massive shift in assets around the world. So in a multipolar world, you have typically inflation normalizing at 3 to 4%. In a unipolar world, like from 1980 to 2020, that can be a situation where inflation can normalize at 1%, 1 to 2. But what we found is, look at from 1966 to 1980, the last time we were in this multipolar world with elevated inflation, supply chains that aren't as efficient. You've got the Suez Canal, problems there, problems in the Panama Canal, problems moving things around the world that creates inflation. Power of labor creates inflation. Labor unions are more powerful than ever. Bigger government, bigger spending. So all of that creates like this different portfolio. And from 1966 and 1968 to 80, materials, oil and gas, and industrials got up to almost 50% of the S&P, 49% in 1980 of the S&P was companies that were in those groups: materials, oil and gas, your metals, mining, materials, industrials, and oil and gas. Mm-hmm. Now those groups only make up 14% of the S&P, those three groups. And that's because we've come the last couple of years, last 20 years, we've been in this unipolar world. And so the situation in the Middle East with the transportation of energy, where there are actually supply of energy in the world, like Russia produces almost 9 million barrels a day. I mean, it's a tremendous amount of production that comes out of Russia. If they in an election year, if they pull back production, or if they or if they team up with other countries in the world that are, because the US has been sanctioning so aggressively emerging market countries, we have less friends. We've used sanctions. This is one of the things in our book. We've used sanctions when you use sanctions, they should be used once a decade as a really strategic weapon.
Mhm.
But both Trump administration, Obama, Biden, they've all aggressively used the sanctions. So, and that goes back to 2008. And so the president, the executive branch controls this since 2008 through Democrats and Republicans, mainly Democrats. They have overused this tool, so we have less friends in the world. And so that creates a ton of risks for energy because the US is producing a lot of energy, but we still, have problems globally with demand. India, there's a billion people in India that don't have air conditioning. 1 billion people in India don't have air conditioning. And guess what? We've taken 5 million jobs out of the United States, 5 million. We've exported them around the world. So we've raised the standard of living in Bangladesh. We've raised the standard of living in India. So if you're a 22-year-old, 25-year-old young man or woman in a call center in India, you're making 100 times more than your great grandparents.
Mhm.
And so the demand for energy relative to supply over the next decade. So think about this. Since 2014, there's 900 million more people in the world, 900 million. And because we decimated the Rust Belt and pushed a lot of these jobs around the world, these countries in emerging markets, we're actually creating new young carbon consumers at an accelerating rate. They're buying those mopeds. I mean, just look at moped sales in India. It'll blow you away, right? And so you've got people that are consuming energy that their grandfathers and fathers were not. And so we're creating all these carbon consumers, but the capital expenditures for oil and gas and metals in, say, 2014, if you took that path, this is a chart in our book, but if you took that path from 2014 to today, 2014 to 2024, we're about $3 trillion behind on that investment plane. In other words, if you took where we were in investments, what we call CapEx, for all the companies in oil and gas and metals in 2014, you took that at the current pace and you moved it to today, we're $3 trillion behind that with a global population that's up 900 million human beings. And we've raised the standard of living in the developing world. This sets up for, I think, a nearly certain energy crisis in 2025, 26, because we've created too many new carbon consumers in the world. Demand relative to supply is just massively located. And it's going to take, 5 or 6 to 10 years to get that CapEx, that $3 trillion into oil and gas and metals and uranium to balance out the planet. And that's kind of the main thesis of the book.
So, obviously that's a major driver for energy, Larry. Where do the drivers sit for the precious metals? We talked a lot about the risks to the banks. I don't know if you analyze how rate cutting cycles affect the metals, but how do you see the drivers going forward for the precious metals as well?
Well, everybody knows the silver components in electric vehicles. Everybody knows about the silver components in solar panels.
Mhm.
So there's a great bull case for silver over the long term. But when the Fed's hiking rates, if you look at PMIs they basically created a manufacturing recession. So the ISM PMI data in the United States, the LEI, the leading economic indicators, have all been negative for a long time in recession territory. And that really hurts precious metals. It hurts industrial metals. But when it comes to precious metals, more so, when the Fed's hiking rates, there's so much money in T-bills, and if money's in gold or silver, there's no interest. So if you can get 5% in a 6-month T-bill, a 1-year T-bill,
Mhm.
you're not going to, there's a disincentive to own things like precious metals.
Mhm.
But if the Fed starts to cut rates, the moment the Fed cuts rates, the performance of precious metals over the last 20, 30 years has been spectacular. But when they're hiking rates and when they're saying things like higher for longer, that suppresses the value. So let me give you an example. In December, we had a very famous Fed meeting where Powell, because of the stress in the banking system, and we heard this firsthand from people in the chat. People in the chat were saying in October, when Bank of America was down almost 50%, that Bank of America would be insolvent with a 6% Fed funds rate. And before December, the Fed was promising higher for longer in a very aggressive way. And the amount of rate hikes that were expected in the futures market, SOFR futures, there was a lot of rate hikes expected because we had a Fed that was promising higher for longer. And there was a lot of things going on in the world that led people to believe that they actually could pull it off. So there was tremendous stress in the banking system from October to December. So at the December Fed meeting, Powell did this very mysterious walk back where he went from like higher for longer and he started talking about, like I said, talking about rate cuts. And if you look at Barrick Gold or the gold miners, from that Fed meeting to say mid-January, we were up from, I think, from those fourth quarter lows, we're up 30%. And now we're right back down because inflation is surprised to the upside. The Fed has to talk tough again, but they can't go higher for longer because they're going to break something. But as long as that they can portray that they can go higher for longer, and as long as you're not breaking something, gold and silver miners and gold and silver are going to be in some relative pain. But but if you just look at the banking system, if you look at 30%, 20 to 30% down in some of these banks relative to the S&P that's up 30%, you know there's something brewing. It hasn't transitioned yet into pain in the high yield market because the high yield market is being supported by higher rates. So people are just like loving these yields. These yields are much higher than they were in the last decade. And so the credit markets haven't buckled yet. But on the consumer side, the defaults within auto loans, within credit cards are starting to move up really aggressively. And so we have the financial conditions are really tight, whereas corporate financial conditions for the corporations are really easy. And that's what's creating a lot of these dislocations. And so the bottom line for the Fed and for precious metals is you need really a surprise on unemployment, something that's going to stop the Fed in that regard, or you need a surprise in credit risk in the banking system. One of those two things would stop the Fed, and that's where you could get in 2016 when the Fed reversed from the first quarter of 2016 to I think August. The gold miners were up 140%. So very fast. So the moment the Fed starts to tip their hand to a softer path, as we saw in December, the gold miners are going to be off to the races. But for right now, there's just not enough things that are very apparent that can stop the Fed. But I think that's going to change dramatically over the next 2-3 months.
And Larry, part of your thesis as well here as we enter what you've dubbed the green meadow. Obviously, we're going to need more lithium, copper, iron, aluminum, all of these different commodities that go into building new vehicles, new ways of producing electricity. We've seen some recent car manufacturers back away from their plans to keep expanding and or just getting into the electric car market at all. So how does this play into your thesis at this time, and does it change it at all?
Yes, and that gets back to if you look at the solar TAN ETF versus say the cash cows, so which is it's TAN versus COWZ. The TAN ETF has a lot of companies that are financing to the green meadow, and the green meadow is kind of a sales pitch that we received from Washington, from Wall Street around the next 20 years, and carbon neutrality by 2030 in some countries, 2050 in others. I think carbon neutrality is going to be more like a 2090 situation. But that has created a real problem for let's look at lithium, look at like ALB, Albemarle. That stock is really much cheaper now. And every time it's gone on sale since 2018, this is the second time we've been through this. The first electric vehicle run up got overdone, and lithium demand expectations got too high, and stocks like ALB, which produces lithium for electric vehicle batteries, got way ahead of themselves. And now this is now the second rendition of this. You're not going to stop the move to the green meadow. You're going to slow it down. But the problem is when you slow it down, you create higher energy prices, which eventually is going to drive more people toward electric vehicles. So it's a slow moving problem that is going to play out over the next couple of years. It's a balance. But electric vehicles with cheap oil are less attractive. If oil goes back to $100, you're going to see a lot more demand for electric vehicles. And so it's very cyclical, and the market goes up on euphoria and down on impatience on a lot of trades. Just look at things like Apple and this electric car and the autonomous vehicles, right? You look at companies that produce semiconductors for autonomous vehicles. That sector was going crazy a year and a half ago. And it's not just for electric vehicles, it's for autonomous. The whole thing was just nuts, and not just Tesla. There's 40 other companies that are tied to this charade. And it's a charade in the sense that you go up on euphoria, down on impatience. It's going to play out, but there's going to be tremendous cyclicality between the certainty and the timing. And so you want to play those ranges. And you see it with all kinds of different stocks. But I think it's very certain we're going to the green meadow. We're just going to get to it at a much later date.
Excellent, Larry. We've been talking a little bit about your book here, and remind us of when it's going to be coming out.
Well, we're going to have events in New York around March 20th. It'll be out on the 26th. And we've got great endorsements from Mark Cuban, Neil Ferguson, Greg Zuckerman from the Wall Street Journal with nice accolades, Ian Bremmer. And so we've got a lot of great comments so far. It's selling well, pre-selling. We've got, I think we're up to 4,000 or 5,000 books in pre-sale. And so our first book was a New York Times bestseller. It's now in 12 languages. It's called The Colossal Failure of Common Sense. And it's ranked it's in the top 20 all time at the CFA Institute. And as a former Lehman trader, I tell my wife, once a month, say if we sell 1 million books, we'll break even on our Lehman stock, right? But so we're really looking forward to the second book, and we think it's going to be a real big hit. And
of course, it's entitled "How to Listen When Markets Speak," right?
Yes, and I prefer When Markets Speak, but the publisher, they know what they're doing. They want the how to listen when markets speak, and there's a lot of really great tips. We sit down with David Einhorn, billionaire. We sit down with David Tepper. We're sitting down with some of the the most brilliant investors. Some of the people are from the chat are in there, really brilliant investors that we're bringing out to a larger audience and really sharing those kind of gems with them. I sat down with Charlie Munger in Omaha.
Saw that
years ago, and he's in the book. We sat down for an hour, 45 minutes in Omaha, and he gave me some really nice gems that we put in the book too. And Charlie was a billionaire that was Warren Buffett's partner. He just passed away. So God rest his soul.
Excellent, Larry. Well, I really appreciate your time and sharing some of these lessons with us and giving us a little sneak peek onto your book. Of course, all of your info is available at the beartrapsreport.co, as well as you're an excellent Twitter follow at ConvertBond, and all your links are available on there as well, right?
Yes. Appreciate it, Tom.
Larry, thanks so much for your time and sharing all your thoughts with us today.
Okay. All the best, my friend.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.